Welcome to Crypto 101, a first principles jargon-free course on blockchain and its impact on financial services. We are currently learning about the decentralized finance application called Compound. In this lesson, we will continue the discussion on Compound. To recap from the previous lesson, there are 5 functions a user can perform on Compound. In the previous lesson, we covered lending. In the previous lesson, we were learning how lending occurs on Compound. Next, we will continue with that discussion. We have learned about supply and borrow rates. The supply rate is the rate earned by lenders. The borrow rate is the rate paid by borrowers. The supply rate is higher than the borrow rate. Next, we will learn why. There are 2 factors that explain the difference between supply and borrow rates: the utilization rate and reserves. Next, we will examine each one of them. Utilization rate is the share of the liquidity pool that is being borrowed. Consider 1,000 lenders who contribute $1 each to the liquidity pool. The supply of loans to the liquidity pool is $1,000. The actual demand for loans is $500. Let us say the borrow rate is 10% on the 500. But the interest at which the lenders should be calculated on the amount lent, which is 1,000. Hence the supplier's rate will be 5%. The second reason supply rates are lower than borrow rates is reserves. Reserves is the portion of interest that is set aside for the protection of lenders. Think of it as a rainy day fund. Reserves are an additional precaution in case the collateral cannot be liquidated for its full value. We can now come up with a mathematical formula for utilization rate. The numerator is the total amount borrowed. The denominator is the sum of total unutilized USDC in the credit pool plus the total borrowed amount. We need to subtract from the denominator the amount set aside as reserves, which are non-lendable. We have explained why supply rates are lower than borrow rates. But how are the absolute values of the rates determined? The math behind the models is outside our scope. However, we can cover the intuition behind it. I am on the Compound Finance app. On the bottom right I can see the utilization rates and the interest rates. Currently, the USDC borrowing pool is about 81% utilized. This graphic is actually an interactive tool. If I lower the utilization rates, the borrow and supply rates fall. Thus, the interest rate is determined by demand and supply. Notice that up to the current level of utilization, the relationship between utilization and interest rate is broadly linear. But beyond this point, there is a kink in the curve. To the right of this point, rates increase much faster for a given utilization rate. You may be wondering why the interest rate is not dependent on the credit score of the borrower. After all, this is how traditional finance works. Next, we will address this question. The credit risk of a specific borrower is not relevant to Compound because of 4 reasons. First, the loan is over-collateralized. But this is true even of our home loan. This brings us to the second reason. The collateral is locked and can be seized programmatically. Third, the seized collateral can be sold easily on an exchange. Fourth, the market value of the collateral via Oracle price feeds can be tracked near real time. The combination of the above factors reduces risk and makes a credit score unnecessary. This brings us to the end of the discussion on the lending function. The next function we will cover is the withdrawal of a loan. Loan withdrawal refers to the process by which a lender can exit her loan position. A lender can exit her position in 2 ways. First, she can sell the C token. Second, she can withdraw the base asset deposited into the lending pool. Next, we will review each option. I will now go to my MetaMask wallet and try to sell the CUSDC token. MetaMask does not let you sell for fiat currency, but you can swap with another token. I select the C token and hit on swap. I enter a small amount of the CUSDC token that I hold and try to swap for another token. In this case, I choose Ether as the target token. I see that there are no open buy orders on the exchange and my quote is unfulfilled. Next, I will try with a larger amount of CUSDC. I hit on the max icon so that my entire token balance can be swapped. Again, I don't get a quote. I can try to swap with a different token and perhaps that will work. But at this point, we can conclude that the CUSDC token is not very easy to trade. However, remember that we can always withdraw the C token and get back the interest capitalized value of the token in USDC. In fact, this is precisely what we will do next. Before I withdraw the loan, I will try yet another action. I will try to send the token to another Ethereum address that I own. The private key to the other Ethereum address is held by Exodus Wallet. Next, I switch to my Exodus Wallet to retrieve the Ethereum address. However, I notice that the Exodus Wallet right now does not support the CUSDC token. What this means is that even though my Ethereum account can own the C token, it will be very inconvenient for me as a non-technical user to process any further transactions if I don't have a user interface in the form of a wallet. The original loan balance on the upper left shows 1.0004. I click on Withdraw USDC. I am asked to enter the amount I wish to withdraw. I enter 0.0004. This is the interest I have accrued so far on my original loan. I submit the transaction. Notice I am paying nearly $6 of gas for this transaction. Obviously, in real life, it would not make sense to process a transaction where the fee exceeds the value of the transaction. But this transaction is for demonstration purposes. Let us wait for the transaction to be processed. When the transaction is confirmed, we can see the interest earning balance on the upper left is now 1. Prior to this transaction, the balance was higher by the amount I withdrew. Next, we will review this transaction on Etherscan. The transaction was initiated from my MetaMask address, even though I was using the Compound Finance user interface. This was possible because Compound was integrated with MetaMask. The destination address is the Compound Finance smart contract address. 2 ERC20 token transfers occur in the exact opposite direction of the lending transaction. First, the USDC token is transferred back from a Compound contract address to my MetaMask address. This transfer of ownership is registered at the USDC smart contract address. Second, the CUSDC token is extinguished for the amount equivalent to the withdrawal amount. We are now ready to move on to the next function in Compound, namely borrowing. Borrowing is a more complex two-step function. First, the borrower supplies collateral. Then, the borrower borrows against the collateral. On the left, we have the assets which are eligible to be supplied as collateral. Currently, my MetaMask wallet shows that I have only 2 eligible assets with a balance. These are Ether and Uni. I choose to supply Ether as collateral. After entering the amount I wish to supply as collateral, I submit the transaction for confirmation. I will now go back to the Compound Finance app to view the result of the transaction I just processed. On the left I can see the amount of Ether locked as collateral in equivalent USDC. On the bottom right I can see the amount I can borrow including collateral value and borrowing capacity. We will now research the supply collateral transaction on Etherscan. I am on my MetaMask wallet app. I click on the Activity tab. I pull up the invoked transaction. This transaction represents the submission of collateral. Then I view the transaction on a block explorer. This pulls up Etherscan. We can see that the transaction was initiated from my address whose private key is held in MetaMask. The destination address is a Compound smart contract address. A total value of 0.001 was transferred from my address to the Compound smart contract address. We see an additional ERC20 token transfer in this transaction. This is rather strange because all we did was supply Ether. Hence, no ERC20 token should have been involved. Next, we will investigate this further. We can observe the sequence of events triggered by the supply collateral transaction closely. First, Ether was transferred from my address to this Compound address. Then this Compound address triggered a transaction to another smart contract address called Wrapped Ether. In exchange, this contract address received a Wrapped Ether token of an equivalent value as the original transferred Ether token. This Wrapped Ether token conforms to ERC20 standards. The Wrapped Ether token received was in turn transferred to the main Compound smart contract address. These steps appear complicated. Hence, I will simplify what happened visually in the next slide. Ether was transferred from the collateral supplier to Compound. Compound took the Ether and exchanged it with an equivalent Wrapped Ether token. Hence, instead of keeping the collateral as Ether, Compound transformed it to another token whose price will be identical to the Ether token but conforms to ERC20 standards. What is the reason for converting Ether to Wrapped Ether? The Wrapped Ether smart contract converts any Ether received into an ERC20 compliant version of Ether. The purpose of this conversion is to enable easier interoperability with other ERC20 tokens. For instance, the loan against the collateral is being made in USDC, which is an ERC20 token. Hence, it is easier for Compound Finance from a coding and programming perspective if all tokens were ERC20 compliant. Wrapped Ether evolved as an Ethereum blockchain-level utility solution since Ether was created at a time when the ERC20 standard was not in existence. We are now ready to borrow. I am going to go back to the Compound Finance app. We can see on the left that we have deposited Ether as collateral. However, I don't see a borrow icon. The reason is that we are currently lending USDC. The app doesn't allow me to borrow and lend the base asset at the same time. Hence, I must first withdraw USDC. Even when the withdrawal is in pending mode, Compound activates the borrow icon. This would allow us to post both borrowing and withdrawal in the same transaction, thus saving gas fees. I enter the amount I wish to borrow. But we now see a message that mandates a minimum borrowing of 100 USDC. I don't have sufficient collateral to borrow 100 USDC, hence, I will not submit this transaction. However, from a learning perspective, at this point, we should have a good understanding of how Compound works. The function of repayment of borrowing is a simple reversal of the borrowing transaction. The ownership of the base asset is returned from the Ethereum address of the borrower to the Compound contract address. The supplied collateral is released back to the borrower. If the supplied collateral was Ether, then it is first reconverted back to Ether from wrapped Ether. We are now ready to move on to the next function in Compound, namely liquidation. In the previous lesson, we developed a conceptual understanding of liquidation. In this lesson, we will delve into details of the liquidation process. Consider Alice, whose loan balance is $120 denominated in USDC. Her collateral value has fallen to $100 denominated in Ether. Alice is underwater. Enter a liquidator, Bob. Liquidators are professional traders who are looking for arbitrage opportunities. They are continuously searching for accounts that are underwater. Liquidators run queries on the blockchain via APIs to identify Ethereum addresses which are underwater in Compound. Bob initiates a liquidation transaction directed to the Compound smart contract with Alice's Ethereum address as liquidation target. On receiving the liquidation transaction from Bob, the Compound protocol returns 120 USDC from its reserves to the lenders. This reduces the reserves of the protocol. It also seizes the collateral of $100. In this scenario, the collateral is denominated in Ether. Note that the reserves are held in the base asset, USDC, hence, Compound will exchange the Ether collateral for USDC via a decentralized exchange prior to selling to a liquidator. Next, we will cover this final step of the liquidation process. Bob buys the collateral at a discount of 5%. The percentage discount is determined algorithmically. In our example, Bob pays $95 in USDC to Compound. He then immediately sells the Ether collateral on an exchange for $100, making $5 in the process. In decentralized finance, liquidations or margin calls are crowdsourced via incentives, while in centralized finance, it is the lender who leads the liquidation process. Large number of traders are constantly running queries on the blockchain to identify arbitrage opportunities. Hence, liquidation is a highly competitive business requiring high level of sophistication. This brings us to the end of this lesson on Compound. At this point, we have covered all the 5 functions of the Compound decentralized finance application. In the next lesson, we will conclude our discussion of Compound with some broad reflections. Before proceeding to the next lesson, review the summary of this lesson. See you shortly.